morning and welcome live from Palm Beach. You're going to hear the guy cutting the lawn in the background. Nothing I can do about that. There's a lot of lawn here to cut, and he started early. I thought I was going to be ahead of him, but in fact, he's an early riser as well. So, good morning. I am Kenny Polcari, your host of the party, and today is July 6, 2022. And here's what you need to know. Chaos in the oil markets yesterday as the dollar surges to 2-year highs, putting commodities under pressure. And everywhere you look, you see signs of a recession every single place. And what do we have for dinner tonight? We're going to have the Veal Scallopine. We'll get to that in a minute. So where do I begin to tell the story of how great a love could be, the sweet love story that is older than the sea? Where do I start? That was Love Story, Andy Williams, 1971. So again, I ask, where do I begin to tell this story, to reveal the complete chaos yesterday? Everything flashing: recession, stocks, bonds, commodities, housing, precious metals, and the Atlanta Fed. The markets are caught between lower growth and higher inflation, a place where we may not want to be, but we're surely going to find ourselves here for a bit longer. We're here now, and we're going to be here for a bit longer. As discussed last week, economists are now actively working to change the definition of what a recession is. Suddenly, the two negative quarters of growth, 2 quarters in a row, that defined a recession for decades no longer defines it. So just throw that definition out. It doesn't work in today's environment. It's so last century. So stocks came under early pressure yesterday morning, falling more than 2% across the board as Americans came back from the long holiday weekend before finding support and rallying into the end of the day in the last hour. The erratic trading emblematic of a world gone wild. Algorithms now in control, driving prices down and then driving prices up all in 6 hours. At the end of the day, it was falling bond yields that was credited to helping save the day. The Dow ended down 130 points, which was a real win considering it was down 700 points at 11 o'clock in the morning. The S&P gained 6 points. The NASDAQ, the real winner, added 200 points on those falling bond yields. The Russell gained 14 points, and the transports ended up, like the Dow, giving back small, 75 points. Oil plunged by 11%, falling more than $11 a barrel to end the day below $100 a barrel, slicing through not one, but two trendline supports, both the 50 and 100-day moving averages, as supply disruptions hit the North Sea. China went back into COVID lockdowns, and the real fear of a recession sent traders into a tailspin, causing demand destruction discussions and supply chain disruption discussions all day. The Wall Street Journal defining oil prices being pulled lower. I would dare to say that prices collapsed under the weight of soaring inflation and the fear that every central bank has lost control, including the Fed. Prices were not pulled lower. Buyers stepped aside, leaving a void in demand, and that caused prices to plunge. Remember when oil went negative? Do you remember April 20th, 2020, when COVID hit? They blew right through zero on their way to negative $38 a barrel. When nobody could drive, you couldn't go out of their homes, the world stopped spinning, big cities turned into ghost towns. Do you remember that? Negative prices, just so you know, it was like having Bloomingdale's pay you to come in and take the clothes off the rack. That's what negative prices are. And then the world reopened, right? COVID subsided, the world reopened. Demand soared. Life came back, and oil went from negative to positive, and then more positive, and then more positive again, surging to the recent high of nearly $140 a barrel. Demand surged, and Joey, as promised in his campaign, elected to change U.S. energy policy, vowing to put the fossil fuel industry out of business, limiting U.S. production in order to go green to satisfy the left, all while OPEC Plus cut back on production, reducing supply, forcing prices even higher because the Saudis and the others needed to balance their books, right? Remember, the COVID destruction caused all kinds of financial difficulties across the board, especially for the big oil producers where they get the bulk of their revenues, right? And then in February, Vlad decided to cause even more trouble, forcing the West to impose sanctions on Russian oil, taking even more supply out of the global chain, sending prices even higher. But the sanctions did little to hurt Vlad. He just sold all of his oil. He's selling all of his oil to China and India, at slightly discounted prices, to continue to fund his economy and his war on Ukraine. And just to be clear, Vlad is selling more oil now than before his invasion. Yeah, maybe it's slightly lower prices, but he's still selling more oil. So more oil, lower prices still equals lots of money. Goldman, RBC, and JP Morgan all telling us to prepare for higher oil prices, while Citibank is at the other end of the spectrum, telling us to expect to see prices collapse to $65 a barrel by Christmas. And so you ask, what happened? And while all this was going on, the CPI in the U.S. blasted up and through 2% in May of 2021, the level that the Fed promised was a turning point, but proved to be nothing other than a data point that the Fed chose to ignore. And with every month, prices rose, getting more and more pressure on the Fed and other central banks to do something to stop the rising inflation. But they didn't. They didn't do anything. In fact, you could argue that they only helped to further ignite the flames as they continued to stimulate the economy, keep rates artificially low past the point that was needed. And so here we are. And so, here we are finding ourselves way in over our heads. Rising prices around the world now taking its toll on the global economy, all while central banks hint at big changes ahead in monetary policy, causing all kinds of disruptions and mispricings in assets around the world. And that could not be more obvious than in equity prices, bond prices, soon to be housing prices, and crypto prices. We've seen them all collapse this year. Tech taking it from every angle. The NASDAQ down closer to 30% year to date. Individual names down even more. While the S&P, Dow, Russell, and transports are not that far behind. Bitcoin and Ethereum getting whacked, falling more than 70% from their highs seen in late 2021. And NFTs, oh right, those things, they evaporated. Poof, gone, just like they did to Dr. Seuss. One day they're here, the next day they're not. So I haven't heard anybody talking about that exciting NFT market. The markets have suffered a lot of internal damage over the past 7 months while everyone tries to handicap the next Fed move. Multiples on the S&P have gone from 24 times earnings to 16 times earnings, and all that means is that prices have to adjust lower. And now we have the recession knocking on our door. Remember, it wasn't supposed to knock on our door until sometime in late 2023, according to a handful of analysts. But like so many other things, you can't control it. So here it is. And so I ask again, where do I begin? Right? Because now we've got all these problems, much more than I think we anticipated 6 or 8, even 8 months ago. 10-year treasuries only adding to the angst as investors pile into the safety trade, sending yields into a tailspin. Yesterday, they ended the day yielding 2.79%, down from last week's 3.3%. And commodities, yep, they've fallen as well. The Bloomberg Commodity Index, otherwise known as the BCOM, has fallen 20% since June 1st, leaving it still up 17% year to date. The dollar index now trading at 2-year highs, up 11% on the year, which is part of the reason why we have commodities in decline, because as the dollar gets stronger, commodities should weaken. It's an inverse relationship. Like treasury prices and treasury yields, right? Prices go up, yields go down. So when the dollar gets stronger, commodity prices should come under some pressure and vice versa. In the end, much of what we're seeing is a direct result of investors trying to reprice these assets based on the current and future economic expectations, which, by the way, isn't unlike what it always does. But this time it's a bit different. Investors have to grapple with higher cost of living expenses and higher interest rates and lots of uncertainty surrounding economic and monetary policy, both here and abroad. So expect to see more volatility and angst in the markets in the weeks ahead as we move through, the Fed meeting next week, ECB coming up, the Bank of England. This morning, what do we see? Well, futures were weaker in the early morning, but have since rebounded a bit, leaving the futures flat. At 6 o'clock this morning, they were essentially flat. There were no big moves in either direction. Economic data today includes mortgage apps, and this is going to speak directly to the housing market, but it also includes 2 key metrics, right? These are very important. The S&P Global U.S. Services PMI expected to come in at 51.6, and ISM Services PMI expected to come in at 54, both trending lower over the past 6 months, getting even closer to the neutral line of 50. We're also going to get the June FOMC minutes, where I do not think we're going to hear anything new, but expect everybody to be sure to listen, just in case they hear something that maybe they didn't hear before, or they're going to read something between the lines. European markets, though, are a bit higher this morning. They're all up about 1% across the board after being down 2% yesterday. There's nothing specific driving that action, just more thrashing around as investors try to price in what's next. And what's next? Well, you know what's coming, and it's earnings. right? They are due to start next week here in the United States on the 14th, JP Morgan, and they're keeping investors on edge. Estimate revisions are lower. They're coming in lower, and they're coming in high gear. But remember, it isn't the earnings per se that's going to drive the next move, unless, of course, they completely miss the mark. But rather the guidance that the C-suite offers in this quarter, that guidance will be even more important. If we're in a recession, what will the C-suite do to manage it? And if we aren't in a recession, what is the C-suite going to do to prepare for it? Because it's coming one way or the other. We're already seeing signs that companies are rescinding job offers, and others that are signaling layoffs ahead, right? We've seen that over the last couple of weeks. Rising input prices are putting pressure on margins, and that margin theme will be a big theme this quarter. Companies that have been pricing power will be able to maintain margins, while companies that do not have pricing power will see margins get crushed, and investors won't like that at all. Now, you can't be completely blind, because if you're paying attention, you're going to see this coming. And what will the multinationals say about currency conversions? A stronger dollar means that when multinationals take their foreign revenues and they convert them into dollars, they get less dollars, right? It's a stronger dollar, so it's just less dollars, which to me means absolutely nothing. Because any good analyst should have already accounted for that currency conversion, and any good CFO should also have accounted for it. And if you're an investor, you should know that. So any dislocation created because of a currency issue is a buying opportunity if the broader fundamental story remains intact. So do your homework. Now, if the currency conversion reveals less money because sales are falling off or the climate has changed, that's a different story. But if the story remains the same, it's an opportunity. The S&P closed at 38.31, up 6 points on the day after testing as low as 37.42. This morning, futures are suggesting continued confusion. The Fed indicating that they are willing to accept a recession in order to prevent something worse, which would be a change in consumer behavior that will keep inflation alive. So consider yourself forewarned. And then move on. Look for support at S&P 3600 and resistance at S&P 4000. A failure to hold at 3600 will see a flush, while a surge up and through 4,000 could see the S&P challenge 4,200 fairly quickly. If neither happens, then we're going to remain in this purgatory between support and resistance. So stay focused. This is not the time to get rattled. Continue to put money away in a tax advantage account. Certainly, if you're nervous, keep it in cash. Just put it away in the account so it's there when you want it. And if you want to continue to put it to work, do what I say. Take advantage of the dollar cost averaging, because there's a lot of stuff that's on sale. And now's the time to, you're going to look back at this and say, geez, I should have, I would have. What did I do? What was I thinking? Okay, so what are we having for dinner? This is a veal scallopine. It's rather simple to make. It's in a lemon, wine, and butter sauce. Hello, butter, it's me. It's fairly simple to make, and it's always, you can whip it up easy when you get home from work. It doesn't take you more than half an hour. For this, you're going to need 10 pieces of veal scallopine, pounded thin. You need salt and pepper, flour, butter, oil, dry white wine, parsley, finely chopped, chicken broth, and fresh lemon juice, right? So squeezed fresh lemon juice. You want to start by taking the pounded scallopine pieces and season them with salt and pepper. Then dredge it in flour and shake off any of the excess flour, right? You don't want to have it, awash in flour. Just shake it off. Now, in a large saute pan, you want to melt like a half a stick of butter and add in a splash of olive oil so that the butter doesn't burn. Brown the veal on both sides for about 2 to 3 minutes. Remember, it's thin, so it's going to cook quick. Remove and set it aside. Now, to that same saute pan, you want to add the chicken broth and you want to add the white wine. You know me, I always use Pinot Grigio Santa Margarita because I can't help it. I like to drink it, I like to cook with it. Right, so 1 cup of white wine and 2 cups of chicken broth. Bring it to a boil and then add the fresh lemon juice and the parsley. Add the veal back to the pan and let it simmer for about 5 minutes, and then it's done. So this whole thing, maybe it takes you half an hour. Serve it on warm plates with a vegetable of your choice, whatever you want. What always looks nice, and always serve it with a mixed green salad dressed with simple olive oil, lemon juice, salt and pepper, and a little bit of oregano, right? You can put tomatoes, cucumbers, scallions, whatever you want in there. And for your vegetable, I don't know, maybe you do French cut green beans, or maybe you do broccolini, or maybe you do sweet potato, something, whatever you want. In any event, look, it's a gorgeous day here. It's a little bit cloudy, but it's not going to rain today. The sun is out, the water is calm, and until tomorrow, take good care.